everyone. Thank you so much for joining in. Welcome to India Factoring Chat Show, Factoring, one-stop solution for your global aspirations. I'm Vinothvasan, your host for the day. Today, we have an eminent speaker to join for the show. Before getting to the show, let me take you through India Factoring first. India Factoring offers working capital solutions through the factoring product aimed at converting your receivables into cash. The company is a subsidiary of a European bank, FimBank PLC Malta, and is registered with the RBI as an NBFC factor. India Factoring is also 83 category authorized dealer. Through our global network, we offer one-stop shop solutions around receivable finance. Today, our speaker will talk to us about global trade finance ecosystem, technology in trade finance, factoring, etc., and solve all your queries pertains to trade finance and factoring. Please stay tuned. Let us welcome our speaker, Andre Casterman, founder and managing director, Casterman Advisory. Andre Casterman is a globally recognized leader in trade finance, digital assets, and tokenomics, advising technology firms, financial institutions, and traders on tech-driven solutions. With over 3 decades of experience, Andre drives adoption of digital negotiation instruments, Web3 technologies, and tokenization technologies, helping clients navigate the evolving landscape of blockchain-based finance. As a board member of the International Trade Finance and Forfeiting Association, Andre chairs its influential fintech committee, guiding banks and institutions in adapting digital assets and attracting institutional investment to trade finance. In 2019, he founded the MLETR Focused DNA Initiative to advance digital negotiable instrument using Web3 technologies, and the TFD initiative to bring trade with capital markets and the real-world asset tokenization technologies. More recently, he launched the Financial Crime Compliance Initiative, enhancing compliance framework for digital finance using verifiable credentials and trust ledgers. Welcome to the show, Andre. Glad to connect with you.
Thank you, Vinothvasan. Nice to be here.
Nice to meet you too. Can you please give us a big picture overview of what Casterman Advisory does and who you serve?
Yes, certainly. So I've been setting up this boutique advisory 11 years ago in 2015, when after having spent 24 years at Swift. I got into trade finance more than 20 years ago when I was at Swift, and I thought that was quite attractive given the low level of digitization and the complexity of the market. Having worked on payments in the late 90s and early 2000s, I thought much of the cash management and payments activities, at least from the Swift perspective, were already digitized, whereas trade finance offered more opportunities to drive change. So when I left Swift, I decided indeed to focus on trade finance technologies. And over time, I have expanded these activities in terms of advising fintechs and financial institutions in terms of adopting advanced technologies. I have expanded those activities also to the liquidity discussion, how to help fintechs source liquidity from new providers, such as asset managers. And this is indeed because at the level of ITFA, which I joined in 2015, I set up 4 initiatives to basically drive change around digital negotiable instruments, is all around digitizing the bill of lading, bills of exchange from notes, but also driving the trade receivables as an asset class for asset managers and capital markets. So trying to bridge our banking space with the structured credit world of asset-backed finance, and suggesting trade receivables as a easier to use asset class than ever before, thanks to various providers. And then later, indeed, I set up a few years ago the compliance initiative with some of our ITFA members, and more recently even the tokenization working group, because indeed tokenization, as we will discuss, is also entering our space and being more and more integrated into law. The whole purpose is basically to focus on aligning technologies with legal and regulatory frameworks, because for regulated institutions on the banking side, on the factoring side, on supply chain finance, regulatory compliance is a matter of survival. So new technologies are only relevant when they comply with applicable laws. Once we have this alignment, or sometimes at ITFA or ICC, we drive this alignment, we can deliver to the market early adopters. And early adopters are essential as role models to show the way and
Yeah.
demonstrate that indeed change can happen. So
Great.
that's about it on my side.
Okay, that's great. Fantastic to hear. It's a wide area spectrum. Casterman advisory covers starting from technology, trade finance, connecting fintechs, and adaptation of tokenization. So that's great. And let's move on to the market specific questions. And over 40 years of experience in the market, specifically in the role of ITFA, World Trade Organization, and International Chamber of Commerce. Please tell us about current global trade finance ecosystem, especially on factoring and supply chain arrangements.
Yes, indeed. I've been working with the ICC also when I was at SWIFT, because SWIFT had developed some trade rules for open account instruments. And I thought when I took over that project, I was asked to look into it. And I thought it's not the role of SWIFT to define the trade rules. It's the role of ICC. So back in 2010-11, we rewrote those rules from an ICC perspective with a working group. And those rules were operated by SWIFT Technologies. So indeed, a collaboration, whether it's through ITFA, WTO, ICC, BAFT, and many others, is essential because everyone has a role to play. In terms of driving indeed change, whether it's at legal level, regulatory influence, advocacy, or technology through members like ICC and ITFA members. So the global trade finance ecosystem is, in my view, fascinating given the complexity. And that's why the level of digitization hasn't progressed, hasn't reached the level we see in payments. Because in payments, basically, we debit before we credit. So the risk is limited. Whereas in trade finance, whichever instrument we're talking about, we extend credit and we hope to be able to get it back through a debit. And that is introducing a number of risks that, of course, India Factoring is managing through the services you offer. But that makes the whole trade market, very, very interesting and so more juicy for those who are happy to get along and support the mitigation of those risks, or sometimes, of course, underwriting those risks like banks do and credit insurers do. The key changes I have seen in the market, of course, is the growing importance of credit insurers and brokers, of course, because indeed the banks, through the consequences of the global financial crisis, have been shifting risk from their books to the credit insurers. So we have worked a lot on ICC at ITFA level, following some work by ICC 15 years ago, indeed, but to demonstrate indeed that the trade asset class is very robust. However, still, the impact of regulatory rules have indeed increased the collaboration between banks and credit insurers. And that's for mainly the unfunded side, the risk side. Another key change I have seen, which I think has to continue growing, is the public-private partnerships or collaboration, making sure that we on the market side, on the private market side, whether we're working for a bank, a factoring, or tech company, or even for an association, important is to be able to engage with authorities who can drive change. And my key reference here is India. indeed, with what the authorities have done with threats. For instance, in 2014, defining rules of the game in order to increase liquidity being extended to SMEs at domestic level. But that is an outstanding vision that authorities had, and I'm sure they got feedback from the private market. So it has been the result of a collaboration between the private sector and the authorities in order to define the rules of the game. And in the end, we have now, indeed, after a number of years, private platforms adhering to the threats rules and framework. And those who benefit most are indeed those platforms and the SMEs that are getting more liquidity. And sometimes it's also helping the banks because the rules can be such that the banks benefit or the lenders benefit thanks to those SME-focused rules. So cooperation is definitely happening within the private sector, but also between private and public. The next challenge we have going forward is working with authorities to fight fraud and finding ways to indeed define rules, use technologies to fight mainly the double pledging fraud, which is hitting us in trade finance, in factoring, and also in structured credit, mainly fraud around trade receivables. So all of those challenges mean that I consider this space as really fascinating.
Yeah, absolutely. So we have perfectly touched upon the points, the government and the private partnership and the risk involved when we do trade finance. It is giving credit, so it's always the risk is more. And I wanted to cover some more points here because we India factoring we provide a complete non-recourse factoring for our exporters. So we take credit insurance from our counterparty bank in buyer's country, globally in US, Europe, or any part of the world, and through that, this is going complete non-recourse to the exporters. So what we are seeing the change in the last 5 years, most of the customers prefer to have this non-recourse exposure because of the changing geopolitical risk and etc. And also, as you clearly mentioned, public partnership here now in India is grooming a lot because now TREDS platform started and there are factoring regulation acts, many new rules for the factoring services in India has been applied now very clearly. So the business is expected to grow from the traditional banking to more into the factoring, and NBFC business is growing. So that is a change. So I think globally it is happening. So good to hear from you as well. And we want to specifically understand how the fintech and the NBFC's part into this, the trade finance and factoring. It is emerging globally and in India, and you can give us some light on this.
Yeah, we have seen indeed bank de-risking in the past, following the Basel regulations. The banks, following capital adequacy rules, Basel rules, have indeed de-risked from some less profitable sectors, let's say, smaller clients, basically. And this has created an opportunity for new players, basically, to take care of those SMEs. Indeed, factoring has been growing tremendously, and also supply chain finance platforms. So technology has indeed been applied by those new players. But I would think the fintechs represent two categories of players: those who are effectively selling technology to any corporate, SME, or financial institution, bank or non-bank. So pure technology vendors, which are essential. Take compliance, for instance, and or back office systems. And the second category are the non-bank originators, which are also often referred as fintechs, but they are not selling technology. They are more focused on the fin side, extending liquidity, acting as an originator, and facing all the challenges that banks face, in addition to not having their own liquidity. So being an intermediary between SME market and the liquidity providers. And those non-bank originators have been quite indeed successful in some cases because they were starting from scratch, so less legacy to take care of, new models, and often the starting point has been supply chain finance and growing and democratizing supply chain finance down market where the banks were less active. I don't see that as competition to the banks, and I don't think the banks see that as competition either. I see really limited competition between fintechs and banks in trade finance, whereas in payments, this is completely different because in payments there is head-to-head competition, take the Revolut of this world, and the competition is obvious. But again, it's because indeed everyone is focusing not from a volume perspective, because in payments you think about volumes. In trade finance you think about balance sheet capacity, profitability. So the volume is not the priority, but it's really the profitability that is the of essence in our space, which is why everyone is focusing on specific segments where their services are matching the expectations. For instance, large banks will take care of large corporates who have much more complex needs in terms of trade, FX, cash management, versus those supply chain finance platforms helping DS or factoring players, helping the SMEs who don't have all of those complex cash management or FX expectations. So these are the two categories of new players we have seen. Now, technology, is not a panacea. Technology is useful when volumes grow and you need to automate. Take reconciliation processes, for instance, or electronic invoicing, or when you handle large volumes of supply chain finance and receivables financing. Technology will help to indeed exchange information, standardize the information, reconcile cash flows, and analyze the information for credit scoring. Technology can also be used for fighting fraud. These are the most advanced use cases where basically you analyze all the cash flows to detect whether an invoice has been financed twice. And this is only possible if the SME opens up their full book to the lender. But that's a way basically to also use open banking APIs to make sure you have, as a lender, full visibility on the financial flows of the SMEs you are financing. And over time, we're going to see more and more. We'll talk about this a bit later. I assume we're going to see more and more in the future technology being applied to increase visibility further, to track transactions further, and to indeed continue in our quest to fight this fraud attempts, fake receivables, or double pledging.
Okay, thank
That's
you.
how
Thanks.
I see it.
Thanks a lot. And we have a viewer's question. Let me take. This is from Shiva. We are increasingly encountering situations where European buyers are unwilling to disclose their financial statements to credit insurers. As a result, Indian exporters face significant challenge in obtaining credit cover. So, could you please advise whether there are any regulated authorities, official registry where they can source this buyer's financials?
Yeah. So indeed, not disclosing information, of course, will not help those corporates. I guess we are talking about larger corporates because SMEs would have less issues to share their financials with credit insurers. So I think that's where the European buyers are unwilling to disclose their financial statements to credit insurers. Okay, that's strange because they should see those credit insurers. Yeah, of course, they are not the clients of the credit insurers. The whole benefit is for the exporter.
Yeah.
So
So he's asking,
Yeah.
some of the buyers in Europe, they are not willing to share. So is there any registry, like in India, we have a ROC kind of, the government registry where we can pull out buyers' financials. So similarly, in other European country, is there any access to pull out the financial? That's what actually is trying to ask.
Yeah, in many countries, you would find indeed public financial statements, or
Okay.
you would have specific, but the situation can vary amongst countries. But
Hmm.
financial statements usually is a basic piece of information you find on. Sometimes you have to pay some data sites to get access, but it's negligible, I would think, given the importance of the matter. You not always have a credit bureau in each European country, so that may be
Okay.
different. But you have private players who
Hmm.
are focusing on pulling all this information and giving it back to um, uh, their clients, any client who is going to pay to get access to that information. But I agree that it could be a challenge here for the European buyers to share financial statements with credit insurers that they don't depend on, because
Hmm.
they will be asked to share that information to help the exporters, not to be covered by themselves. So there is a bit of a challenge here in terms of data sharing. Um, but then you have indeed, it's really up to the credit insurers to source that information from other places, because financial statements are available on European companies, usually from other places, if not from the source itself, the corporate,
Okay.
the European buyer, then from a data aggregator, I would expect.
Okay. Thank you. Thanks, Andre. So just to add up here, India factoring, we deal with many European market buyers, and we do come across some of the buyers not ready to share because they are operate under family-held closed companies. So those situations, we introduce our counterparty bank because we are taking from import factor credit insurance. We introduce our counterparty bank to the buyers. They will enter into a NDA arrangement and they will share necessary disclosures. So that is a way they can able to solve. But some buyers they totally close, so that we cannot help. And introducing our counterparty bank, a local bank to the buyer, it always help to provide solution for most of the deals. Hope
Yeah.
this answers for Siva's question. And now we have another question from Ramanathan. Sir, banks and factors are expected to support MSMEs while simultaneously tightening fraud controls. What technological innovation is most likely to reduce fraud while making credit access easier to MSMEs?
Yes, that's, I think, the holy grail is how to be comfortable that the SME is, or the MSMEs is worth it. The model I've seen also recently in France by a non-bank lender going very deep in the SME market is basically to use to require the MSMEs to share their full book of their full accounting book, and that means disclosing through open banking APIs um, all of their cash flows. Because when you analyze it, and that's where technology helps, because we're talking about larger volumes of cash flows. Because if you really have nothing to hide as an MSME, why wouldn't you share? You're after liquidity, so give the data, and that data will be used by the lender to ensure that your clients are paying on time, that you're not pledging invoices twice with another lender, and that is really MSME level visibility that uh, I have seen successfully being implemented. Again, it's all about the willingness to share. Back to the previous point, not everyone is happy to share, but if we're talking specifically about MSMEs and they have nothing to hide because they are not faking receivables and they are not double financing receivables, then they will be happy to share all their full book. Open banking APIs achieve to pull that data from different systems, so the technology is quite easy to implement. It's a decision to share that is the key.
Okay, great. Thank you. Thanks for the feedback. And we'll move on to the next one. Yeah,
Sure.
we have another question from audience. Let me take this one. And here, this is from Roni Chirian. Dual financing may happen in cross-border factoring as there is no global invoice registry. How will global fintechs and NBFCs manage this?
Yeah, that's more complex, indeed.
Yeah.
And the market doesn't have a solution yet. Now, we have seen solutions for fighting double financing being implemented at country level. In India, in Singapore, more recently, there was an initiative in Bahrain, and other countries are working on it. This is where public-private partnerships are important, because as soon as we're talking about sharing of data, banks and regulated financial institutions need an approval by the regulator. We need to be comfortable that they are allowed to share the data. And also, they need to be motivated to share the data, because if they share the data, for instance, about the fact that they have financed a receivable, they're going to do that effort to protect their competitor, the other bank. So the regulators have a role to play as orchestrator of the rules of the game again. Again, India stands out because those rules have been defined a long time ago, and we see the positive impact on the market. But that is only at domestic level. When we
Yeah.
talk about cross-border, far more complex. There is no solution today. No solution
Yeah.
today. Technology could help, but will never be sufficient, because you need someone to, first of all, reassure, as I said, the banks that sharing of data is acceptable from a regulatory perspective, because data protection, data privacy, and so on is important, and then someone who are an authority forcing the market. And there is no global authority in trade finance. There are global influencers like ICC or ITFA and others, but no global authority at that level. Over
Yeah,
time, I think we could combine technology, traceability technology, so having a stamp on invoices, having a unique ID on invoices, with some market practices that we could define at ITFA, for instance, and influence the market, but we will never be able to force the market to assign a unique ID to an invoice, so that we can store the unique ID against a pledging decision, for instance, in a ledger. So that is the concept. Is attractive. What we're missing is the authority to make it happen.
Yeah, that's absolutely correct. So here you mentioned a very correct point. There is no global body to organize the registry. So I hear that there are various countries, they are already on the way to set up a registry, but there is no connection globally to verify until it get connected globally. And as you correctly mentioned, the unique ID is given, then the entire the purpose will not be solved. So hopefully, I think in the future we may expect all these developments. Yeah.
Yeah.
So there is another question from Purushothaman. There are multiple options for exporters to choose when it comes to factoring, like platform, NBFCs, fintechs, banks, buyer supply chain. Which one is the best option for an exporter to choose?
Yes, there are multiple options, because there is no one size fits all in this business. It's trade finance is always a consequence of an agreement between two businesses, and in this agreement there is a level of negotiation and a balance of power that defines the type of payment term, financing term, that both will end up including in their contract. And as a consequence of that, we have partial advance payments, we have letters of credit, we have indeed other options, supply chain finance, where both parties collaborate to indeed move the liquidity. So there is no single better option. It really depends on whether you wanted a technique where you agree with the counterparty to go in one way or another, like supply chain finance. You need the buyer approval to finance the supplier at transaction level. Or you could also have a second category of techniques where you can do it on your own, like selling receivables. You can sell receivables without asking, indeed, your counterparty whether they agree with this, unless there are, of course, restrictions defined from the start. So usually all of those options exist because they are relevant to someone. There is no single market here. There's no single instrument, single market. And I would say even the traditional legacy techniques from the 20th century, like letters of credit and international factoring, remain today because they continue to be relevant despite the 21st century innovations we have seen. Could be even 25 years ago in the early 21st century, such as supply chain finance. And all of those coexist. It really depends on your current situation. And I see some of my clients also looking for more liquidity, open to combining different options, basically, because for businesses at international level, the key is to get the working capital liquidity. If they have to enter via the one or the other instrument, they will do it, and they need advice from institutions because the smaller they are, the more limited their expertise in terms of all the available options. So that's why this market continues to be fascinating, because the older techniques continue to be relevant and the new techniques also find their niche.
Absolutely, yeah. As you mentioned, there is no specific best model, this worst model. So this is all more specific to the requirement of the exporter. They can choose any of the arrangement. And I wanted to add up here from the more Indian exporting perspective. So as you mentioned, there are multiple options are here in India. And if you take India factoring, we do. We are coming under RBI approved NBFC as a regulated NBFC in India. We will do a limit size of up to 20 million USD, and generally in fintechs category, the limit size are a little more smaller size, up to 1 million, 2 million. They focus more on the number of clients. And if the exporter choose to go to the bank, then it may come as a loan to their books, because it is secure lending. So it will add up the strain their balance sheet. So it depends on here. Going to the bank anyway, their finance arrangement will get settled, but still it is a secured loan. And coming to an NBFC like India Factory, it is unsecured and complete non-recourse. Buyer credit protection is provided 100%, and the limit size, and we can cater to MSME, mid and large corporates, since we provide limit up to 20 million. So these are the various options, as you clearly mentioned. More specific to the client need, they can go with. And many of our clients, they even use from all the options. If it is a larger client, they use multiple options, because that is how we are. We have another audience query. So here, what is your overview of Indian market typically export to European countries? Is there any change in the viewpoint after India and the EU trade deal?
I think, yeah, there are already very extensively used options like the one you offer at India Factoring, and then you have the whole banking system, of course, with letters of credit and guarantees and other capabilities offered by banks. Over time, I'd like to look at how we can use electronic bills of exchange between India and Europe. Europe is geared towards MLETR, the Model Law for Electronic Transferable Records, which enables the digitization of promissory notes and bills of exchange and bills of lading as well. So all of those negotiable instruments. UK English law has indeed been upgraded in 2023. French law has been upgraded in 2024, and German law and Italian law are being upgraded now. How can we, New York as well, how can we bring the benefits of those new digital options? But they are new, but the instrument is still the same. It's still a bill of exchange, it's still a promissory note or a bill of lading. But how can we make sure that the Indian exporters can benefit from this? We believe at ITFA that the bill of exchange is an excellent instrument as an irrevocable payment undertaking that is independent from the underlying contract, and has been a bit abandoned in some regions because it was required on paper. This is where supply chain finance schemes have developed their proprietary IPUs based on contract law. But now we have the bill of exchange written into law, English law, French law, and others. As I said, how can we indeed go back to that instrument, a very established instrument from a legal perspective, not change the instrument definitely, but having another medium, paper to electronic, so that we can finance at transaction level when relevant as well. And combining this with documentary credits and combining this with open account, basically. So that's where I think we have to look at those new digital options as opportunities to enrich the portfolio of capabilities.
Okay, that's great. Yeah, let us move on to the next subject, more on the specific business vertical related matters. So currently, we are seeing there are two types of receivable finance arrangements are growing in the market. One is the platform based receivable finance arrangement. Another one is direct lender based factoring and factoring finance arrangement. How do you see both verticals and their growth opportunities in India and globally?
Yep. I think so. The supply chain finance platforms are usually more recent than the traditional factoring, of course, because supply chain finance really takes a tech perspective on dealing with flows, whereas factoring is very established and has gradually, over the last 50 years, embraced the technology. And basically, over time, I think they will converge towards the receivable financing market, because supply chain finance has been probably, from what I've seen over the last 20 years, the most successful digital innovation in our market, from a digital perspective, I mean, because that has been my focus. However, supply chain finance still depends on having an anchor buyer willing to approve the invoices and support their suppliers. So that is fit for particular industries, like when you have large buyers, retail, telecom, and many others, defense also. But when you have indeed the reverse, like a smaller buyer and a large vendor, like in software, take Microsoft, take those distributors. We're talking more about distributor finance, because the buyer of the client of Microsoft, as an example, will not set up a supply chain finance program for Microsoft. So this is where supply chain finance will not work, but receivables financing will be relevant even for large corporates like Microsoft. Supply chain finance has been growing, will continue to grow thanks to those platforms democratizing access to that technique, and so much more to do. Platforms are thriving in that space, whether they are purely software providers or acting as non-bank originators. However, the key to unlock is to move into receivables financing, not necessarily the factoring way with a whole portfolio, but more indeed at transaction level, and because receivables financing can be indeed applied to any topology of a B2B relationship, because it's an independent decision to sell receivables. It doesn't, the seller will not depend on the buyer to approve. And then, of course, risks occur or need to be considered. Is the invoice genuine? Can it be verified with the buyer, even if the buyer has not approved it? And has it been sold already? So there are a number of risks there that need to be considered. And we are back to the points we discussed earlier. But over
Yeah.
time, I think those markets will converge because, as we
Mm.
said, all of those options, instruments are relevant in one way or another to the same groups of clients.
Absolutely, yeah. So, as you touched upon very interesting point there in the portal, the transaction-wise buyer need to give acceptance for the invoices. So, that overall the speed of the transaction is improved in platform. The acceptance when it comes to cross-border transaction, we are finding multiple challenges. Of course, in India, locally giving acceptance for every invoice wise, we see good support from the buyers because this is more government promoted arrangements we have. And when it goes to the international platforms, they are finding it a challenge. And also, as you clearly pointed, when it is a buyer organized anchor based finance arrangement, there is no problem, they are getting all proper acceptance. So yeah, you have your point is very validly you covered that that there is a two segment still we are good to grow in both the segment, because traditional factoring arrangement it's for the different purpose, and the platforms take care of the more anchor specific finance arrangements.
Yeah.
Yeah. So we yeah, let us move on to the next area, more technology specific. We see many fintechs are emerging in the market year on year, and focusing more on technology will help sustainable business. Or do you think any important factor need to be focused for sustainable growth for the fintechs and NBFCs?
Yeah. Indeed, the market, this whole market, in particular, receivables financing, is huge, because indeed bank de-risking continues to have an impact on various businesses. Some large banks have pulled out of commodity finance, for instance. So those involved in commodity finance have to rely on other banks or other sources of liquidity, like trade funds or some platforms. So the market is clearly there and continues to um, attract more liquidity players. Um, but the players will not necessarily banks or traditional players like traditional factoring. It could be indeed more trade funds, specialized trade funds in particular sectors or particular regions. So the liquidity will come from other sources, such as indeed non-bank trade funds, and also more and more from structured credit investors, because structured credit investors, those who are mainly based in New York City and investing in different asset classes like credit cards, real estate, um, and many other mainstream asset classes, easy to access asset classes. Some of them have a foot in the trade receivables space and recognize that it's a bit more complex to understand, to analyze, to access. But indeed, the bridges between those non-bank originators and structured credit investors are making it easier and easier for the liquidity to move from capital markets into our trade space. And this is essential indeed to offer SMEs via those non-bank players access to the liquidity they need. So uh, you so that's really from a liquidity perspective. From a technology perspective, the key trend that we should focus on is to ensure that we are allowed to share data, as we said earlier. The regulators put in place some rules to allow for sharing data. When banks are not sure they are allowed to share data, there are new technologies to share proofs that some checks have been done without sharing the full data. You can prove that, for instance, an identity has been validated through a registry, for instance. Um, and I think the market over time needs to move from indeed sharing more data in different ways, but also verifying data. Being able to verify data with registries, with indeed IDs at entity level, but also at document level and transaction level. So verifying data is where technology can still make a huge difference. And once we have verified data, then machines can handle that data with AI engines for credit scoring, for compliance. They can rely on that data in a trusted way because the data has been verified. So moving the market from exchanging data to being able to exchanging the data and verify the data, so you can trust the data, is really one of the recent focus of the ITFA FinTech Committee, and which is where I set up a tokenization track, because tokenization technologies will help us get there. Not on its own, it needs regulatory support, but this is coming also. In Europe, for instance, we have the electronic identity and digital attestation scheme called EIDAS, which is embracing trust ledgers, blockchains, for indeed exchanging verifiable data around identities and transactions and documents. So we are able to get there.
Okay, great. That thanks you. And more specific to the India receivable finance market, do you see more space for further fintechs and NBFCs in India market despite the traditional banking arrangements? How do you see in the next 10 years?
Yeah, I think we're going to see some platforms becoming non-bank originators, because in terms of valuation and indeed profitability at transaction level, more platforms will understand that if they transform their technology expertise and technology stack into a non-bank financial institution, an NBFC, for instance, they will grow their valuation, and they will be able to not only sell technology, but being able to extend liquidity. And for the clients, the SMEs in particular, the key is not the technology, the key is the liquidity. So we're going to see some platforms moving up the value chain and keeping on developing technology, but not selling technology to SMEs for them to access liquidity from banks, but really becoming non-bank financial corporations and BFCs, and acting as full originators. Whether they move up further the value chain to become a full bank, that is a bit more challenging, because you don't need to become a full bank necessarily. You can already expand drastically by moving up the value chain from tech to non-bank financial institution. And I see that outside of India as well, some tech people in logistics, in trading, that are preparing to become really lenders, expanding from their trading activities and expanding to acting as a lender. And that is basically where their own profitability will increase, but also the market will benefit more, because at the end of the day, the SMEs are not looking for technology, they are looking for liquidity, as I'm sure you very well know at India Factoring, because that's your core business.
True.
So that's how I see the evolution. of the market. Everyone, I think, over time, the vision would be becoming specialized banks, not
Yeah.
global banks, not fighting the big banks. No one wants to fight them necessarily, but being very focused on a particular sector, particular geography, particular industries, and extending the liquidity as a bank would do, but in a very specialized way. So becoming very specialized banks is how I see those platforms and B2B players, some of the B2B players evolving.
Yeah, that is interesting. Actually, more specialized banking, the environment we are seeing already started seeing in India now. Many banks and NBFCs are coming up instead of the generic lenders. They are getting focused into more the market product or specific segment wise. So that is actually good. So it will improve focused finance arrangement to the specific need of the customer. So that is a wonderful idea. I think going forward, the customers will get more benefit out of it. Yeah,
I could phrase it, if you allow me. I could phrase it in this way:
yeah,
uh, trade receivables financing doesn't need to stay a banking activity. You can
absolutely.
embed trade receivables financing into a B2B logistics platform, a
Okay.
transport company, a trading company, and because those people involved in the B2B activities, they have the expertise to mitigate risks in the B2B sector. So they know all the data points they have to collect and how the risks need to be mitigated. So, as they are experts in the B2B flow, adding the financing is easier for them. When you are a generic player in like a new bank, setting up from scratch, you have no expertise in the B2B flow, you have no expertise in the banking space, and you're trying to basically act as an intermediary between the two, which is risky for new players.
Yeah.
So either you have the expertise in banking, like banks, factoring companies, established, they know from a financing perspective what they're doing, or and uh, or you are expert in a B2B sector. Again, it's really transport companies or some specific traders. They combine their expertise with a financing uh, service for their sector only. They don't want to be generic, and they're becoming specialized lenders in a particular sector. And they will partner with banks to source more liquidity, or with asset managers. Partnership is what they want, but
Yeah.
they combine their B2B expertise with the banking. So trade receivables financing doesn't need to stay locked into the banking space. It is being integrated into B2B uh, 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 platforms, traders, and operators, we could call them.
Yeah, that's very interesting point. I think we'll be seeing in the future how this is going to change the entire trade finance arrangements. And we are already running out of time. And thank you so
Yes.
much, Andre, for taking your time to share your insightful thoughts on global finance and responding all our audience questions in a very detailed manner. And thank you so much for your time. Thanks a lot.
Thank you, Vinod. Pleasure.
Thank you all. Hope all your questions were answered. And if you want to know more about factoring or India factoring, you can visit our LinkedIn page or get into our website for our direct contact number available for the branches. And I'm signing off. We'll be back with another interesting subject shortly. See you then.